Hello, this is the 43rd episode of What Would Peter Lynch Do? Exploring the wisdom of legendary investor Peter Lynch. A listener asked, I want to invest in TSMC, a global semiconductor factory that has driven the rise in semiconductor stock prices. Can I invest in the U.S. stock market? That is a really sharp question. And it gets right to something a lot of investors wonder about, maybe find a little confusing sometimes. How do you invest in these amazing international companies like TSMC without, dealing with foreign stock exchanges directly? So today, that's exactly what we're doing. We're taking a deep dive into how you can access these global players right from your U.S. brokerage account, making it all accessible and hopefully pretty straightforward.
Absolutely. It's really important if you're looking to diversify, to broaden your investment horizons. The financial world has come up with some pretty clever ways to bridge these gaps between countries, and we're going to unpack how these foreign companies, from chip makers to big consumer brands, actually manage to get listed and trade right here on U.S. exchanges. It's probably not as complicated as it might seem at first glance.
Okay, great. So let's use TSMC as our main example here, since that's what the listener asked about. They see the ticker TSMs on the New York Stock Exchange, but they know it's a Taiwanese company. How does that work? How does a company based in Taiwan end up trading here?
Right. For TSMC, and actually for many big global companies, the main route is through something called an American Depositary Receipt. You'll often see it just called an ADR. TSMC specifically trades on the NYSE, the New York Stock Exchange, using an ADR.
An ADR. Okay, what exactly is that? Can you break that down a bit?
Sure. Let's try an analogy. Imagine there's this fantastic snack. Let's say it's TSMC's original stock in Taiwan, but you can only buy it over there. Now, trying to buy it directly yourself, that could mean currency exchange hassles, finding an international broker, maybe language issues, is complicated.
Right, sounds like a headache.
Exactly. So what happens is a big U.S. bank, think like Citibank or BNY Mellon, steps in. They go and buy a whole bunch of those actual snacks, the Taiwanese shares, in Taiwan. They hold on to those shares, and then they issue snack coupons here in the U.S. Those coupons are the ADRs.
Oh, okay, so the ADR is like a claim check for the real thing held by the bank.
Precisely. You can then buy and sell these snack coupons, the ADRs, on a U.S. exchange like the NYSE using your U.S. dollars. No need to deal with the Taiwanese market directly. The bank acts as the bridge.
That makes it much clearer. So applying that to TSMC specifically, how does that work? How do those coupons relate to the actual TSMC shares?
Good question. So the original TSMC shares, they trade on the Taiwan Stock Exchange. Their ticker symbol there is 2330. For the U.S. market ADR, the bank bundles 5 of those original Taiwanese shares together. And those 5 shares create one ADR. That single ADR is what trades on the NYSE under the ticker TSM. So when you buy 1 share of TSM in the U.S., you effectively own, or have the rights to, 5 shares of the underlying stock in Taiwan.
5 to 1. Okay, that's important to know. So besides just being easier to buy, are there other practical differences for an investor between holding the TSM ADR versus somehow holding the 2330 stock directly in Taiwan?
Yeah, there definitely are some key differences to be aware of. Obviously, the exchange is different, NYSE versus the Taiwan Stock Exchange.
Right.
And the ticker symbol TSM versus 2330. The currency is a big one. US dollars for the ADR, new Taiwan dollars for the home stock. But there's another characteristic. The ADR price, TSM, while it's obviously tied very closely to the price of the underlying shares in Taiwan, it doesn't always match perfectly.
Well, what is that?
Well, the ADR can sometimes trade at a slight premium or a discount compared to the value of those 5 underlying shares.
What causes that difference?
It can be a few things. Think about different trading hours. The U.S. market might be open and reacting to news when the Taiwan market is closed, or vice versa. There can also be factors like currency exchange rate fluctuations that haven't fully caught up, or even just differences in investor sentiment between the two markets at any given moment. Sometimes demand in the U.S. is just higher or lower.
Interesting. So it's not always a perfect mirror image?
Not always perfect, no. For most long-term investors, these small differences aren't usually a major concern, but it's good to know they can exist. Also, things like dividends work slightly differently.
How so?
You still get the economic benefit, the dividends, but they're typically paid to you in U.S. dollars after the bank converts them. And importantly, they often have foreign taxes withheld by Taiwan before you even see them.
Taxes. Always something to consider.
Yeah. And voting rights are usually handled through the depositary bank, too. You generally get the voting instructions, but it's processed via the bank rather than you voting directly as a shareholder in Taiwan.
Okay, so some mechanical differences, but the core economic exposure is there. Now, you mentioned this is common. It's not just TSMC doing this ADR thing.
Oh, not at all. It's extremely common. You find tons of major global companies using ADRs to list here.
Why do so many do it?
Well, the main reasons are access to capital and visibility. The U.S. has the biggest, deepest pool of investment capital in the world. Listing here lets them tap into that. Plus, listing on the NYSE or NASDAQ gives them a huge boost in sort of global recognition and credibility.
Can you give some other examples? Big names we might know.
Sure. Think about Alibaba from China. That's Baba, an ADR on the NYSE. Or from Japan, you've got Toyota Motor, TM, and Sony, SONY.
Right, okay.
From the UK, there's the pharmaceutical giant AstraZeneca, AZN. Even from Brazil, Petrobras, the energy company, PBR. All household names, all accessible through ADRs in the US.
Wow, okay. So it really does open up the world for U.S. investors. Now, this brings up something else we hear about direct listings. Companies like Spotify or Coinbase did that. How is that different from what TSMC did with its ADR?
That's a great question because they are different routes to the same goal, getting shares traded in the U.S. You can think of it as sort of two main paths, indirect, like the ADR, and direct.
Okay.
So the ADR, as we said, is indirect. A bank creates these receipts based on foreign shares. The company itself isn't issuing shares directly onto the U.S. exchange. The big plus for the company is often it's simpler, maybe less regulatory hurdles compared to other methods. TSMC, Alibaba, Toyota, those are ADRs.
Got it. Indirect via the bank. So what's a direct listing then?
Direct listing is, well, it's exactly what it sounds. It's the company directly registers its own existing shares for trading on a U.S. exchange. The key thing here is usually they aren't issuing new shares to raise fresh capital. It's more about providing liquidity for existing shareholders, like early investors, employees letting them sell their shares on the open market.
Ah, so it's not primarily about raising money for the company itself.
Not typically, no. That's a major difference from a traditional IPO. And the opening price isn't set by bankers. It's determined by supply and demand right from the start.
Why would a company choose that route?
Often it's seen as potentially cheaper and faster than a full-blown traditional IPO. You mentioned Spotify, SPOT, and Coinbase, UIN, perfect examples of the method, even though they happen to be U.S. companies. The process itself is the key difference. So the simplest way to think about it might be who lists what. With an ADR, a bank lists a depositary receipt. With a direct listing, the company lists its own shares.
That makes the distinction very clear. And for the investor, like we touched on with TSMC, even though an ADR is technically a receipt, in practice you get the dividends, the price moves with the company. It feels pretty much like owning the stock.
Broadly speaking, yes. The economic reality for the investor is very similar. The behind-the-scenes plumbing is just different.
Right. Okay, this leads perfectly into the listener's second question, which was, so are there cases where a foreign company does an IPO in the U.S.?
Excellent question. And the answer is yes, absolutely. That's another very common and important way foreign companies come to the U.S. market. It's distinct from both ADRs and direct listings.
Okay, so a third way. How does an IPO differ?
An IPO, an initial public offering for a foreign company, is when that company decides to create brand new shares and sell them directly to U.S. investors for the first time. The primary goal here is usually to raise a significant amount of fresh capital for the company itself.
Okay, new shares, raising money. Can we use this snack analogy again? How would that fit?
Yeah, let's try that. Remember our Korean snack company? The ADR was like a U.S. distributor selling coupons for existing snacks. The snack company didn't get new money. The direct listing was like the company getting permission for existing snack holders to sell their snacks in the U.S. Again, no new money for the company directly. Now, for an IPO, imagine that Korean snack company wants to build a huge new factory in the U.S. To fund it, they create a special U.S. limited edition new snack. These are the new shares. They sell these new snacks directly to U.S. consumers and use that money to build the factory.
Ah, okay. That really highlights the capital raising aspect. So they sell new shares specifically to fund growth or expansion.
Exactly. That's the core purpose of a traditional IPO, whether it's a domestic or a foreign company doing it in the U.S.
So why go through all the effort and expense of a full U.S. IPO? It sounds like the most complex route.
It often is the most complex, but the payoff can be huge. There are three big reasons. One, access to capital. We mentioned it before, but it's worth repeating. The U.S. market is just unparalleled in size and liquidity. If you need massive funding for big projects, R&D, expansion, acquisitions, a U.S. IPO can provide that like nowhere else.
Makes sense. What else?
2. Credibility and recognition. Successfully going through the intense scrutiny of the U.S. SEC review process and listing on the NYSE or NASDAQ. It's like a global stamp of approval. It signals reliability, strong governance, transparency. That boosts the company's reputation worldwide.
Right, a kind of gold standard listing.
Sort of, yeah. And third, getting U.S. dollars directly. For a global company, raising capital in dollars reduces currency risk significantly. It also makes paying for international supplies, services, or even acquiring other companies much easier if those transactions are in dollars.
Okay, capital, credibility, and currency.
Got it.
Any recent big examples of a foreign company doing a U.S. IPO?
A very prominent one recently was ARM Holdings. They're a British semiconductor design company, hugely important in the industry. They chose to do their massive IPO on the NASDAQ exchange here in the U.S.
ARM, right. Okay, that ties it all together. Wow, that was a really fantastic deep dive. We've covered quite a bit how companies like TSMC use ADRs, the difference with direct listings, and then why a foreign company might opt for a full U.S. IPO like ARM did. Understanding these different routes is definitely key if you want to look beyond just U.S. stocks. And it reminds me of what Peter Lynch always emphasized: know what you own and know why you own it. I think that wisdom applies perfectly here. It's not just about the company itself, but also understanding how you own it, especially with international investments. What are the mechanics? What are the nuances? That principle really goes beyond just stocks, doesn't it? Understanding the how behind things is crucial in so many areas. So as you explore investment opportunities, remember that many of the world's leading companies are actually quite accessible. Thinking about the different listing methods isn't just useful for your portfolio, it also gives you a glimpse into the bigger picture of global business and how capital flows around the world. It really does open up possibilities. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a great day.